Hey everyone, Anton Madley with Peak Market Watch, and I'm here with my colleague John Martinez. Welcome, John.
Hey, good morning, Anton.
Naturally, today we are talking about the Fed that just raised target rate another 0.25% yesterday to 4.75 to 5%. Some market participants felt that with recent turmoil in on the banking side that they would stop raising the rate. We have discussed it before. We felt that that's not going to happen, and I think when we then go through uh, uh, Jerome Powell's press conference, his statements, it's very clear that inflation is still very much on their mind, and so it was not really a surprise. But before we do that, let's. I just have to say it again, and I already made a post on LinkedIn and some other social media. The Wall Street Journal had a article that they published on the front page today. It wasn't just Credit Suisse. Switzerland itself needed rescuing. Go ahead and read that article. It's really silly. Switzerland, as a Swiss American, I'm very familiar with Switzerland. I'm familiar with Swiss economy as well as politics. The only thing that really needs rescuing are the Swiss politicians and regulators that crumbled under the pressure from Janet Yellen and all the other regulators in Europe to coerce Credit Suisse to a fire sale to UBS. So it has nothing directly to do with Fed rate hike, but it's my view is it really has negatively impacted the reputation of one of the major financial markets in the world, and hopefully other financial regulators learn from this and are not going through the same pressure and do it over a weekend without thinking it through. I would say one of my key points is if they provided the liquidity of the 200 billion that they provided to UBS as part of the takeover, that would have calmed the market down sufficiently that it could have created an environment for them to negotiate a breakdown of various divisions from Credit Suisse or a sale to whoever the best buyer would be, but forcing it all through the weekend and then still providing all that liquidity and backstop, uh, writing down 81 to 8 to the bondholders of 16 billion, and providing a backstop of 9 billion on top of the first loss that UBS was willing to take is if they did the same thing to Credit Suisse, I'm very confident that the market would have calmed down, and there was not really any reason to do that fire sale. So now I get off of my uh, complaint here about the Swiss government and Swiss regulators. I can do it because I'm also still half Swiss, right? So I have the right to do that.
Well, Anton, as long as they're still cranking out the chocolates, the
Yeah.
watches, the pharmaceuticals, everything's okay.
Okay, good. All right, so let's jump over to Jerome Powell's press conference yesterday. As usual, he always has that press conference right after they make the announcement. I think it's really important just to highlight again uh, that what is being mentioned over and over, right? But obviously, he started out mentioning that the banking problems, even though they might be isolated, it can, if they are unaddressed, it can undermine the confidence. And obviously, the U.S. government stepped in very quickly with SVB, with Signature Bank, and others. Let's hope that their actions have worked out. Obviously, Janet Yellen has even floated the idea to cover all deposits. Whether that is going to happen or not, let's see. But naturally, they not only essentially came up with an immediate rescue for SVB as well as Signature Bank, including covering all the depositors virtually very quickly. And I completely support that, because that was really necessary to stabilize the system. But what is certainly important is that, right, with the support of the Treasury, Federal Reserve Board created the Bank Term Funding Program to ensure the banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. I think borrowing against those assets is absolutely necessary for liquidity. Allowing it at par, I think that is a questionable approach, right? Some of you already know my opinion about allowing banks to not to mark to market treasuries and agency mortgage-backed securities, as long as a bank claims that they hold them to maturity. That was the downfall for SVB. And now they're still allowing to borrow against par. Just doesn't make sense in my view. But again, that's what they are doing to prop up liquidity at the banks. So the message very clear is, right, there is ample liquidity in the system, and if it's not there, the government is willing to provide that. And that is I would say is only a positive message out there. I don't think that it's that the market is necessarily all believing it, but it's definitely has come down the market, at least temporarily. And again, they are prepared to use all of our tools as needed to keep it safe and sound. Very strong statement. Again, my view is the Swiss National Bank, Swiss government, Swiss regulators could have done exactly the same thing with Credit Suisse rather than going through a fire sale there. Now, turning to the actual reason why he had the press conference, obviously it's the meeting and then the Fed rate hike. And when you listen to him and also read through the transcript, it is very clear that inflation is on top of their mind. There's still, he mentioned it multiple times, that inflation is high. Right. And he also mentioned multiple times that the labor markets continue to be very tight. So as a result, they continue to be strongly committed to bring the inflation back down to their 2% goal. Cannot be clearer in the messaging there, right? Then obviously, he also mentioned that the US economy slowed significantly. But he also then made the statement that it appears that consumer spending has picked up again this quarter. So overall, I think the committee really felt that the economy actually has done better despite all the rate hikes than what they really felt the economy would do, right? Naturally, everyone recognizes that the activity in the housing sector is extremely weak, primarily due to the high interest rates. Affordability is as bad as it has always been. Anyone who is a first-time home buyer is essentially in a very difficult position. And as we know, if someone already has a mortgage, that most people have locked it in somewhere sub 4, very many below sub 3, unless you have to move. You're not going to move, right? Because your new mortgage would be significantly higher. Then again, right, committee participants generally expect subdued growth to continue. So that is a message. Yes, the growth will be subdued, and that's their expectation, and that's part of the reasons why they have raised the rates continuously and very aggressively over the last year or so. Uh, and again, right, labor market, despite all these actions they've taken, still remains extremely tight. Uh, and so when you listen to him on over and over, these two items are just not in going in the direction where they hoped that they were going, both on the inflation side as well as the job market, the labor market itself. Uh, he mentioned, right, that the labor market should come into a better balance over time, but again, over time, it just takes more time than what a lot of people believe. And when you look at their projections for unemployment, it's 4.5 by the end of this year and 4.6% essentially flat by the end of next year. It's still historically seen, it's still a low unemployment figure. And again, he repeated it many times. Inflation remains well above our longer target of 2%. And while it has moderated, right, since the middle of last year, the strength of the recent readings indicates that inflation pressures continue to run high, right, and that is really the reason why they've continued to raise it. Obviously, they have not done it with 50 basis points. That was pre-banking crisis, was still anticipated by many, but some also felt now that they are no longer raising and potentially pivoting very quickly as we move through the rest of the year. Now, when we look at what they are projecting, and remember, right, everyone just has a crystal ball as the other person. They are projecting, no one knows, but they are still expecting inflation of a PCE of 3.3, 2.5 next year, and 2.1% in 2025. So all the way through, certainly this year we still would be well above their target, and the next year we will still be well above their target, getting closer but still above. So in other words, it has a long way to go and is likely to be bumpy, right? And that bumpiness is only what we are seeing in by all the market participants. Everyone is watching every inflation signal that is coming out, every report that's coming out, and depending on where we are, everyone feels, oh, now the Fed is going to pivot, and the next time, oh, now they're not pivoting. And that's really the bumpiness that I think we all should anticipate for some time. And obviously, as borrowers, it's a little bit distressing when we know that we do not have that clear path to downward rates when we still have that overall picture of inflation hanging out longer than what many have anticipated, right? Having said that, Whitey still feels that the committee is of the view that they have longer-term inflation under control, so that we do not have a hyperinflation. Let's hope that they are right? Now, obviously, they're aware that the impact on inflation, particularly on families and individuals that are suffering the most from high costs of food, housing, and transportation. Right, so particularly the lower income households. But again, right, we are strongly committed to returning inflation to our 2% objective. I mean, when you read through that or have listened to him, he mentioned that inflation target multiple times and that you're committed to get there. So my read on this, and John, then you can jump in after we are done through this. My view is that this is clearly what the target is, and that's why I do not really see them pivoting. Even if they've stopped raising, I just do not see them pivoting at all this year, and if they do, it will be very minor. So when we look at, right, obviously they've raised the target rate another quarter to three quarters to 5%. We already discussed that. And that they continue to significantly reduce the securities holdings. Now, this part here, I'm not so sure whether we can trust that that statement completely. Obviously, they opened the liquidity spigot for banks, so they may reduce the securities holdings on one side, but then they will have just another bucket where they can toss liquidity into the market if they wanted to. So that part here, I'm not really trusting when we look at the overall ability by the Fed, how they want to manage the liquidity. And I think that is they on the front side they will stick to the higher rate for a while. They claim that to reduce the securities holdings, but I think they are going to implement other steps in order to push liquidity into the market as necessary. So I think we need to take that statement with a grain of salt there. Now, this one again is important. At least not everyone agrees with this, right? But from their point of view, the economic indicators have generally come in stronger than expected, right? And whether you agree with this or not, this is important to understand when we look at the Fed action. They clearly are of the view that the economy has not as much weakened as they originally anticipated. But they certainly also acknowledge that what has happened in the banking system, and combined with the interest rate raises, that we see a tightening in credit conditions for households and businesses. We already have seen that, right? And we can talk about that when it comes to commercial real estate, and particularly also agency loans in particular. Naturally, right, it's too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. In other words, it leaves it all open for them to determine how they want to respond. Are they going to raise the target rate more? Are they keeping it where it is, or are they even pivoting, right? So this statement, not unsurprisingly, gives them all the freedom to react to what they deem as what is happening, and then justify whatever actions they are going to take. So I would say we certainly have reached a point when it comes to the Fed rate where they do not feel that there is such a strong urgency to continue to push rates up, right? And that statement here really reflects this, right? As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. read into it whatever you want, right? So it's essentially very similar approach to it, just not necessarily just driven by aggressively raising rates. And also, right, if the economy evolves as projected, and remember that's what the committee believes in their projections, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year. So essentially flat, right? So they may raise and then they bring it back down by a quarter. Let's say they raise it by another quarter in the next round, and then may bring it down a quarter in later this year. Whatever it is essentially more or less where we are today. 4.3% at the end of 24 and 3.1% at the end of 25. If we go along this, I think the message for all of us, who including Boris, is 4.3 and 3.1 is still pretty high by historical standards when we look at over where we started out in 2020, late 2020, all of 2021, when we were virtually at zero, right at the quarter point. So it is important to understand, yes, they plan that they can pivot, right, next year and pivot more in 2025, but we are still elevated, still essentially 3% above in 2025 than we were in 2021. So let's keep that in mind. So when it comes to borrowing costs, just thinking, well, we are going to pivot, yes, that will help, but we are still at a very elevated level compared to where we were in doing the COVID times and right after the COVID emergencies. So in other words, in their view, very little has changed since their December projections, right? And once again, we remain committed to bring inflation down to our 2% goal. And that's one of the reasons why all this is still, that's what they are projecting. They just feel that it will take time to get there, right? So that's what he was saying. Obviously, then reporters were allowed, as usual, to ask questions. John, you listened to it. What's your take on his statements, as well as what was your feel from the questions that came from the audience?
Yeah, Anton, I think that from listening to the statement and putting into place that he started his statement talking about the banking crisis, and if you and eventually, I believe, early in the Q&A, he highlighted that the Fed was looking at the rate of inflation as well as job growth being very strong January, February, and that they were possibly of the opinion that maybe they needed to actually turn up the heat a little bit more than they were thinking. But then, short of 2 weeks ago, we began this, essentially a banking crisis here in the last 2 weeks. And so it kind of, gave them a little bit of a relief. I mean, there's a little bit of cover of saying, well, now they would have to wear solely if we go into a hard downturn with no other crisis that, was this Fed driven? Did we come in for a hard landing? Now they get a little bit of relief in that the headline grabbing crisis is this run on banks, and is there confidence in banks? So I think they dodged a little bit of a bullet, got a little bit of breathing room. I'm certain that we would all rather that it's not so bumpy as they're saying. I mean, maybe that comment about bumpy is the market having to digest, what is the uncertainty? How will this play out in the next, couple of months? Will investors have confidence not only that their deposits are safe, but that we are kind of coming into some type of slowdown that can be managed? I'm not of the opinion that the Fed's ever got it right, because it seems that if I recall correctly, they've never kind of put us into this soft landing, but they keep trying. So that's what we'll see. Um, so in the Q&A, that's one of the things that jumped out was a question about what was in their mind as far as being comfortable being able to take this 25 basis point cut instead of we had talked about, okay, well, most likely probably 50 and then another 50, and then we would have to see on the back end of the summer. The other thing I'd comment just in general is the chairman also made a comment about their models, and he stated that the models are linear, but that change effectively that change in capital markets and changes on our economy are exponential. They're nonlinear relationships, and so if you think about it, we anticipate change to be very linear, and I think that for investors, um, it's not. I would be of the opinion that you kind of have to keep that in mind. It's not to doom and gloom that the world's going to come unglued, but that what we just witnessed is one of those relationships where there is a nonlinear event. Where essentially within 2 weeks, we had a Fed that thought they understood what was going on, and then realized, and admittedly so, that well, we don't know what's necessarily going to go on. And it shows in their rate cut as well as in their comment that we'll have to watch. Things could be bumpy, and the other thing that I think stuck out to me, and you touched on this, was his acknowledgement that there's this. Well, it was during these comments, but that there was potential contractionary influence with rates going up. Or excuse me, with the this kind of lack of confidence that there's going to be an impact on rates for lending activity that in turn will have some drag on the economy that doesn't necessarily have to come from their increasing the short-term rates. So, I think you're right. I don't think there's a lot that has changed. I think they got a little bit of a breathing room as far as not having to take action. And, there's a willingness, at least it seemed from the chairman's standpoint, to try to, encourage it. There is a coordinated effort between the Fed, the FDIC, and the Treasury. And I caught a headline late yesterday afternoon. I couldn't track down the underlying comment, but the headline was saying that Treasury Secretary Yellen had made a comment where effectively she kind of did an about face versus where the comments she had in the market on Tuesday was an implicit, we're going to backstop, the Treasury is going to help the FDIC, we'll backstop all depositors, everyone got the warm fuzzies. And then you have Chairman Powell come out and say, yes, we're all working together. And then the headline I saw was that she was explicit that that was not the route that they were going. And so, it's unfortunate, but it seemed to have kind of had some take a little bit of the wind out of the sails late in the trading day yesterday. And I think that unfortunately, it causes the regulators to look a little bit like they really aren't in lockstep with each other, and I think that that's challenging. So hopefully, things settle out here in the next couple of days. But those are some of my initial thoughts. I think we really kind of need to keep in mind that you watch things, have your plan for what your liquidity needs are in the near term, and do keep in mind that when things change, they generally tend not to be linear.
Yeah, good point. And again, right, when we look at the borrowing environment, it's so fluid, right? Obviously, the government stepped in very quickly with SVB, with signature and the orders. That was positive. But as we have discussed in our previous Peak Market Watch session, was that because of the impact all these mortgage-backed security purchases have had, and now all these regional banks and smaller banks are no longer able to buy them up, so now they are dumping them. It immediately has an impact on the demand for those, and whoever is still willing to buy them, they buy them at the better price, meaning the credit spread needs to go up for any new future issuance of these bonds. and we have seen it only on the Fannie and Freddie side on the multifamily loans, where the credit spreads increased by anywhere between, on the low end, 25 all the way up to close to 50 basis points, depending on the program. So this is not the end of the world, and obviously with Fannie and Freddie, it's kind of almost they are almost the last resort lenders when it comes to multifamily. So we are lucky, whoever is in multifamily, that these lenders are available. But for other commercial real estate, we don't have that last resort lenders, and it just doesn't take much until the liquidity is sucked out of the market. And as we already have experienced, it really started already late last year that banks definitely have slowed down their commercial real estate lending significantly, have focused more on their best clients, established clients. So for new borrowers, it has already become much more difficult. And now with the new eyes all on the banks, it's very likely that it's harder for anyone to borrow. And if someone still can borrow, guess what? Banks are likely raising the rates. They may also plan to go shorter. We just do not know, right? But what's only as a message for our clients who are borrowers, be prepared for swift changes. And if you buy a property, get ready for changes from the loan application to closing. Don't expect that everything will stay to just because someone was willing to issue a loan application today, that is still valid in 2 months from now when you close. And I think if you have borrowing needs to refinance, it's even more important that you give it long enough of time, right? We have had that discussion yesterday afternoon. If you just have 6 months left to refinance a loan that matures within the next 6 months, you're against the wall, right? So if you do not have the ability, if the market somehow gets into a distress, even if it's for a temporary period of just a few months, and you have to refinance right during that time period, it can be extremely stressful, and you may not be even able to refinance at the terms and for the loan amount that you would in under normal circumstances to refinance. So my recommendation there is just start the process earlier, so that you are not pushed against the wall without any other solutions left.
Yeah, and it, correct me if I'm wrong, Anton, but if you're inside of that last 3 or 6 months, most refis are not going to have that trailing prepayment penalty, right? I mean, you get into this window where you're cutting it pretty tight, barring yield maintenance. If you've got a 1%, I mean, no one really wants to pay that, but necessarily any more than they need to. But it just doesn't feel like there's a lot of benefit of trying to time it correctly. Just given what we've seen in the last 2 weeks, and you already had the expectation that things could be challenging this year. We were gonna be in an environment where rates were gonna be hard. What was that going to impact in the second half? But I think that if you're kind of looking at that and you're into that final 12-month period, trying to push it into that zero cost for the prepayment penalty, it just might kind of bite you in the event that things get a little shakier as we come into the summer this year. I mean, we're
Yes.
literally 1/4 into the year, and we know that there's going to be a lot of summer activity. Historically, we'll have to see if that still plays out as we go into the summer.
Yes, absolutely, right. I think also, right, many have had a strong view that rates will come down significantly. Uh, and that's why they also are pushing it out, hoping that later this year and the next years the rates will be significantly lower. Uh, Again, the short-term rates, as we discussed, they will come down potentially a little bit, assuming that the credit spreads are not going to increase. But let's assume that the credit spreads stay the same, and let's assume that the Fed fund rate will drop from what their projection is, 5.1 to 4.3 by the end of next year. Obviously, you gain roughly 80 basis points there. So that's a benefit. But for permanent refinancing, 5 years, 7, ideally 10 years of a long term, you may not see any significant change at all, right? I mean, the reality is we still have an inverted yield curve, but that as we get into later this year and next year, that yield curve may flatten out. So yes, the short side may come down, but the longer end of the yield curve may not, right? So so I think obviously it's very hard to predict where rates are going, but I would say be very careful just to wait and wait and wait, hoping to get significantly lower longer term rates onto the book. I just cannot see that is going to happen over the next 18 months, 24
So,
months.
a question for you, Anton. I know that we've talked to some investors that have been, quite successful in the last couple of years of working with, not to our benefit, but with, basically thrifts that have been very aggressive as far as that have been aggressive in lending. As they're outside of the traditional FDIC model as far as being an insured banking institution. When you come into these other types of institutions that have been aggressive, you know, what do you think is their metric? Because they seem to have been more aggressive in the community bank space, pricing things more tightly. I know that I've talked to some folks that kind of feel that that's still maybe a space, but I can't imagine that the levers of credit concerns and their own regulatory oversight would be that much different.
So you mean which lenders?
Excuse me. Now I'm having a hiccup. I'm thinking of our friends in Alabama that didn't go to a community bank. They went to oh my god, what am I thinking of? Oh no, I'm sorry. Golly, my brain is going blank as to who they went to.
Yeah, yeah.
Oh,
So it's okay, right? So there are a couple of lenders obviously out there that have been really aggressive. I would say debt funds were extremely aggressive in 2021, in particular into early 2022. Then regional banks have become as they slowed down, then the regional bank picked up, and smaller banks, local banks picked up a lot of that business in early 22 into maybe early fall of 2022 until they filled all their buckets and stopped. Uh, so I would say that when it comes to the banks, it's only much harder now to get the terms that you were able to get a year ago or longer. When it comes to private funds, it appears that there are still plenty of debt funds out there that are willing to lend. Uh, but my warning there is that they primarily are driven by what their investors are willing to provide in funds. And once their investors get cold feet, then that market will dry out very quickly, whether it's a CLO market for bridge loans or the CMBS market for for traditional permanent commercial real estate financing. Uh, and obviously, on the CMBS side, right now, everyone has the eyes on office buildings, right, and loans that are defaulting or potentially defaulting, that have office buildings on, but that can shift very quickly to other asset classes too, right? We've the retail, large retail like malls that have always been a problem. Multifamily has not been really such a problem, but I still would be a little bit careful there because uh, generally speaking, when a multifamily property goes into a CMBS loan execution rather than an agency loan, there tends to be a reason for that, right? So it's either a weaker sponsor or the property has had some trouble historically. Maybe the numbers are not doing that well, whatever it might be. There are some exceptions to that, but because some borrowers just strictly go by best pricing and they don't care about anything else. Uh, but what we already have seen is whenever we see a CMBS loan on a multifamily property, there always tends to be some story behind that it was where they tried to go agency, but ultimately ended up with a CMBS. So there we suddenly I foresee that we have a higher default rate on CMBS multifamily. So far, it has been relatively small, but that can change very quickly too, right? We just do not know the full impact of all the eviction process, much lower rent growth, extremely fast increasing expenses that a lot of these borrowers are being hit with. And I would say there is just a little bit less of a cushion on the CMBS side. Right.
Yeah, and I apologize. My brain had a glitch there. I was trying to articulate the word credit union.
Okay. Yes. So credit unions are only similar to community banks, right? Uh, I would say whatever smaller community banks are doing or smaller regional banks are doing, we have to anticipate that credit unions are behaving in a very similar fashion, right? So
Yeah.
I suspect that they're, in a lot of instances, their investment portfolio is probably not that significantly different than what a community bank or a smaller regional bank has. Uh, I hope it's not the case, and that they do not have all these long-term mortgage-backed securities that they have on their books that essentially they also would have to market and haven't
Mhm.
done so. Uh, but you never know, right? But I would say overall, we probably have to assume that everyone, regardless of whether it's a credit union, community bank, regional bank, national bank, they all are reviewing their investment processes, whether they have to sell some of their assets at the loss now or stagger it out, and also talk about liquidity, right? How can they ensure liquidity in general, even if they do not have any problems on their balance sheet, which means again less lending and shorter term lending. Which, if I were a bank or a credit union, that's what I would do to ensure that my liquidity position is in better shape, right?
Yeah.
Uh, Now, again, as a commercial real estate borrower, that's a problem, particularly when you also want to have a longer permanent loan, right? For 5 years. I mean, for most credit unions, they still just lend for 5 years. Uh, maybe 7 years, and now you may even have trouble to get a 5-year term. Maybe now they go down to 2 or 3 years, right? So just be aware, right, as a borrower, whatever you were able to get a year ago or 2 years ago, you may not be able to get also if you were lucky enough to get in the low fours as an interest rate for 3 or 5 year term back in 2021. Now it's likely, if you're lucky, in the upper fives and likely in the sixes, even with a permanent loan, right? So
So, you've covered the kind of the waterfront on different types of funding and the impacts that we might see here in the near term. From your discussions, Anton, as you talk to investors, have you gotten any sense that the sales broker community is being more critical as far as they're reviewing offers and whether or not folks, seem to have a very strong plan on the acquisition financing side?
well, I would say most listing brokers, they are struggling with their communication with the sellers rather than with the buyers, right? So I would say at least most of the ones that we are talking with on an ongoing basis, they are well aware of the challenge on the financing side. They are well aware of still the expectation from a lot of sellers when it comes to the price points. Uh, and they are testing the market all the time, right? So they are issuing BOVs, broker opinion of values, left and right. They are constantly getting pushback from the sellers that it's not that they are not high enough. Yet they have the pulse very much on the market because they talk to plenty of buyers too, right? Uh, so I would say right now it's really still that stalemate. And frankly speaking, I would say the problem why we do not have more activity is clearly on the seller side because they are still with that mindset that the price that they would have been able to get in 2021 very early of 2022 that still should be applicable, and it just isn't. Right, so
Yeah.
it's definitely not the buyer side. I think there's still plenty of buyers out there. There is still plenty of equity out there, but the sellers are just not willing to move to the point where we have more activity. Really very similar in a way as in the single family space, right? The single family space is a little bit different because people just decide, oh, I don't need to move. I have a low mortgage. I'm not even thinking of moving. Whereas on the investment side, obviously everyone needs to sell or refinance on a regular basis. That's part of the strategy or the capital event need. But they are just not willing to adjust to the new market environment.
Yep. Okay.
All right. So another round of Fed rate hikes that we have behind us. Let's see whether they are raising it by another quarter point or whether they are going to stick to where we are today, right? Based on what their projections is, we are essentially where we need to be right now. Maybe another quarter point that's going to come. I think it will all depend on where we are with the next few signals from on the inflation side and the labor market. And so we will see, right? It's an interesting time to be in financing and investing, and it's only will be very curious to see where we are by the end of the year, and obviously even more so what's going to happen next year. Unfortunately, we don't have the crystal ball, so we just need all to tie down our underwriting and make sure that we can get through whatever is going to be thrown at us over the next couple of years.
Yep.
Yeah.
All right.
All right.
Thanks for visiting, Anton.
Yeah. Thanks again, John, and everyone. If you have any comments, just make comments below, and if you have any questions, reach out to us. Talk to you soon. Bye.
Take care.